So hi guys, this is Chetan Potdar back again, and today I'm going to be talking to you about a subject which a lot of my students have asked me in the past, and I'm going to try to decipher for you what is an IPO, how does an IPO work, and why I will never invest into it. Right. So again, my name is Chetan Potdar, and I'm a teacher of investing, trading, and how to trade and make money in the stock markets, whether you are investing or trading. And this is my take about what an IPO is, from the experience of 15 years that I have been into the market, and experience of a little more than 8 years of teaching people how to make money in the stock market. So here goes. So first of all, this is the most brutal, practical, and insider man's account of what an IPO is. There is no scope of being politically correct or proper here. If you want a textbook definition, look somewhere else. I'm going to talk to you about things which never get spoken in the industry. I'm going to talk to you about things as a insider's man, to tell you the dirty little secrets of the IPO industry, and finally I'm going to kind of explain to you why I would never invest money into the IPO industry. So in the simplest manner possible, my objective today is to teach you. My objective is not to make a presentation to you. So what is an IPO? For that, let us move over to this particular slide, and let's consider that there are two partners by the name of Mr. V and Mr. A. Now, Mr. V and Mr. A are owners of a company called the Red Car Company. So Mr. V and Mr. A have been manufacturing these cars, have been selling these cars. They have been making a lot of money out of it. They've been making a lot of profit out of it. They are very happy in life. And there you go. You can see that they have been driving their red car, right? Let's try to consider that the total value of the Red Car Company as a business is about 2 crores in Indian rupees. Let's assume that for the ease of it. And but now Mr. V and Mr. A wants to start making motorcycles as well, because they have realized that while there is a lot of money in making cars, there's also a lot of money in making motorcycles. So they're going to need a lot of money for it, right? They are either going to borrow the money as a loan, or they could sell a share of the company and get some money, right? Now let us assume that they are going by the second option that they have, is that they are going to sell some share of the company and get some money. So what will they do? They will go and sell this shares to the public in order to get money. So what is an IPO now? IPO means initial public offering. Since the shares of the company are sold to the public for the first time, it is called as an IPO. Initial. It is the first time that a company is selling its shares to the public. That's why it's called as initial. It is offered to the public, and that's why it's called as an IPO. Now, while I speak about an IPO, there is also something which is called as a term which is called as an FPO, which also means or is called as follow-on public offering. Now what does that mean is, let's say for example, if Mr. A and Mr. P already had their shares listed into the stock exchange, and they further wanted to sell those shares, it's already been listed for last 10 years. They are doing very well. People have bought their shares. Now if they want to dilute some more shares and give it to the public, then in that case it would be called as a follow public offering. So if the company is issuing shares to the public when the shares are already listed on the stock exchange, it's called as a follow public offering. So at this point of time, we are talking about an initial public offering. So what do these guys do? So they decide to sell half of the shares to the company to the public to generate funds, and for that they approach investment banker, also known as a iBanker. What does an iBanker do? So iBanker has got a couple of things which he does, and first of all, what he does is he helps Mr. A and Mr. V to price the shares of the Red Car Company, because we need to mark a price for them. So they will try to find out in the best possible manner what is the price that they can sell those shares. He will also help them to structure and format and the shares so that they can place it in front of the public. He will help them to do with all the paperwork and the different aspects which are required by the market regulators. He will sell the shares to the public on behalf of the company. He will also make brochures and do all the advertisements which is required. He knows a lot of financial institutions to sell the stock. These guys are very well networked. These guys are very well connected, and they can sell the shares to different financial institutions. So basically, the investment banker is going to do all the work of selling shares, and for that they are going to charge a hefty fee for it. Now, who are investment bankers? These are highly intelligent and very well educated guys from top MBA colleges around the world and in India. They have excellent number crunching abilities, very strong verbal and written communication skills, and are capable of working very long hours and grueling hours. So they work very hard, they're very smart, they're very intelligent, they're highly knowledgeable, they are highly skilled, and they know how to sell. It's a very strong, potent skill sets that they have. So who are investment bankers? Now, this is the example of a couple of investment bankers which did initial public offering for one of the more popular companies in India. So banks like Merrill Lynch, ICICI Securities, Citibank, Deutsche Bank, Edelweiss, there is HSBC, there is IIFL. So there are multiple. There is UBS. So these are the different investment banks which will help the Mr. V and Mr. A to do an initial public offering. So now let's try to understand as to who are the people who can apply for an IPO. So there are a couple of categories of people who can apply for an IPO. One of them is called as a retail investor. Now there is a demarcation of how much percentile can be applied in a particular category. So who are retail investors? Retail investors are investors who can apply for less than 2 lakh rupees. The maximum cutoff for them is 35% of the entire IPO. Then there is something which is called as HNI, which is high net worth individual who can apply for more than 2 lakh rupees of issue. Then there is something which is called as NIB, which is non-institutional bidder. Now these are NRIs, there are companies, there are trusts who bid for more than 2 lakh rupees. And finally, there is something which is called as QIB, which is qualified institutional bidders. Now these are large financial institutions. There are large banks, FIIs, mutual funds who bid for a very large amount. The institutions like LIC, institutions like UTI are that would qualify to be called as a QIB. Now let's also understand the terminologies of the pricing of an IPO. So there is something which is called as a floor price. Floor price is the minimum price at which the bids can be made for an IPO, which means below that price you really cannot bid for an IPO at all. Now there is something which is also called as a cutoff price. It means that the investor is ready to pay whatever price that is decided by the company at the end of the book building process. The reason is that retail has to pay the highest price while placing the bids at a cutoff. If the company decides that the final price is lower than the highest price asked for the IPO, the remaining amount is going to be given back to the retailer. So why do people invest in IPOs now? Because their friend recommended and everybody else is doing it. Because your banker or your broker recommended. You see very big and very flattering advertisements right before the IPO is launched, and it's everywhere because they are anchored by very big and powerful investment banks. So you're very impressed with the big and powerful investment banking names because you feel it is a good company. A lot of us, we feel that this is a good company, it will do well, you have a positive vibe of the company. So hence you're going to invest into IPO of that because you want to be a long-term investor and want to buy the IPO at an initial price. You suddenly feel that you want to be a savvy investor and you should invest into the market. So hence you put your money into the IPO. Or you are going to do it to sell at a listing gain or flip the stock at listings and do it for a short-term period. So it could be any of these reasons. Now, why I will not invest into an IPO? There are a couple of reasons for it. Please keep an open mind and have an approach as a professional investor to understand the inside story. But first of all, when you have been asked to invest into an IPO, the question which you need to ask yourself is, who is selling it? What are they selling? What is the objective of the selling? Understand this question. Who is selling it? Mr. V and Mr. A are selling some of the shares of the companies. Why? What is the objective? Is the objective to make money? Yeah, of course the objective is to make money. Is their objective that they build a business and they want to get out of the business? That could also be the objective. So the objective is that, and my caveat here is that if the business is so good and if the business is paying you so well, why would somebody want to sell it? right? That's the question. I don't want to sell something which is making a lot of money for me. Second question, who is doing the actual selling? Investment banks. What is the objective? The objective is to make fees and money for themselves. So whenever somebody is trying to sell something across to me to make big amount of money, I'm going to be always wary. In this whole transaction, whenever there is somebody who's selling something and buying something, you have to understand there are always two parties involved. Somebody who is a wholesaler and somebody who is a retailer or somebody who is a shopper. Now, wholesaler always makes money. Retailers or shoppers always lose money. You have to understand this. This is a universal phenomenon. So who is the wholesaler in this transaction? The wholesaler are the iBanks. The wholesaler is the person who is selling the stock. Who is the retailer? People who are buying this particular IPO. And you have to understand that retailers are always at the short end of the stick. The entire industry is geared towards selling you an IPO, as all of them are getting paid for selling. So please think about what I'm saying to you. Authentication of data. Now when I'm talking about authentication of data, I'm really talking about what is the quality of the data which is offered to you. Now raw data, I would call it as data, but if that raw data has been engineered in certain manner in order to highlight certain points and suppress certain points, then that data I would call it as a engineered data. So whatever data that you're getting even in public domain, who is releasing the data? Is that data being engineered? What would be the objective of engineering that data or beauty draping that data? Why would somebody want to only show the good parts of the data and suppress the bad parts of the data? You have to understand it from this perspective and ask yourself a question. If somebody who is highly intelligent, educated and skilled, what is he capable of doing in order to make fees for themselves? One more question. Are we trained enough, educated enough, capable enough to go through the data and understand the business? And also to find out unwritten, masked or engineered data which has been presented to us. So finally, in order to explain this to you, if a fully trained, experienced and highly paid and the best in the business are using everything they have to sell you a IPO, the question is, are we smarter than them to see through this design? Whenever there is an IPO which is launched into the market, there is absolutely no historical data. Now please understand, whenever a product is launched into the market, it does not matter what is the construction price of that product. What matters is what people are ready to pay for it. Yeah, whenever you are selling a stock, the price that somebody buys it from you is the actual price. So whenever there is an IPO which has been launched into the market, there is no historical data available, and because there is no historical data available, you really cannot make any judgments. We do not know how the market is going to react to the opening of an IPO and what will be the price till the time it has been launched and the market factors in the price. Maybe the IPO is highly overpriced. That is the idea anyway. What is the idea of an IPO? That somebody is selling across to you shares of his company at the highest possible price so that he makes the highest amount of money. So on a very logical platform, an IPO is going to be highly priced. So basically, whenever you are buying into an IPO, the price of an IPO is always an offer price and you are trading blind. You will only know the market price when on opening, and that itself is it's a very scary thing. When you apply, you have absolutely no control as to how many shares which are going to be allotted. Now let us consider that the IPO is made up of only 100 shares. If there are people who are bidding for 500 shares, then the IPO is called as IPO has been oversubscribed 5 times. Let's say if you have 100 shares and the IPO, and there are people who are applying for 1000 shares from that IPO, it's a highly demanded IPO, then it is called as the IPO has been oversubscribed 10 times. Now in that case, what happens is, for all the people who have applied for that IPO, you are only going to get 1/10 of the IPO price, which means suppose if the shares are 100 and 100,000 people have applied for 1000 shares, then you are not going to get 100 shares, you are only going to get 100 divided by 10, which is only 10 shares. So higher the oversubscription, the lower the amount of shares which you are going to get. And now you will only come to know of this at the time that the IPO opens up. Yeah. So how many times it gets oversubscribed and what will be your allotment is a question mark. Your money gets locked in for a long period of time and you may get less than what you applied for. And if your money is locked in, then you are missing out on a lot of lucrative opportunities in the market. And believe me, market always has some opportunities for you. No risk management. Now, whenever you are putting your money into an IPO, there is absolutely no handle on the risk management part of an IPO. If you don't know how much you are going to pay, or how much is your outlay, and how much you are going to get at what price, where is the risk management? So you are applying for an IPO. You don't know how many stocks you are going to get. You don't know at what price the stocks you are going to get. So where is the risk management? If you can't understand, numeralize, describe, or visualize a risk, you can't manage it. Since you can't control the investment amount, you can't also do position sizing, which means you might want to buy 100 shares of the IPO and you are going to end up getting only 5 or 10. So if there is no control over it, it doesn't make sense to me. So because of too much market risk, and anything which you cannot mitigate a market risk, from my point of view, is gambling, and hence I will never invest into an IPO. The data has it that more than 70% of the IPOs drop in value on listing. Now this is the historical data which is available to, in fact 70%. I'm being very kind and saying that it is only 70%. The data is actually a lot more higher. So a minimum of 70% of all the IPOs drop value on listing. Which also means that the very, very high chances that you are going to be sold at a higher price. Have you ever wondered why most of the IPOs get launched when the market is highly bullish or at all-time high? Yeah. Why is it so? The general idea is to ride the market euphoria and to sell your IPO. Most of the IPOs never get launched when the markets are bearish, when the markets are neutral. So the general idea is to always launch the IPOs when the markets are at all-time high, so that when people are very happy because the markets are bullish, they tend to invest into an IPO. Hence launches of IPOs are known in the professional circuit as a soft indicator of markets high. So whenever you start seeing a lot of people who are launching IPOs, we have to understand that market is at all-time high. So please remember that study before you invest, don't pray afterwards. So very quickly, let me recapitulate. You're always going to be sold as a retail novice investor by highly intelligent, educated and structured industry, and they are always getting paid for selling something across to you. The data might be highly engineered by the smartest brains in the industry. You may never have a control on what is the buying price of the IPO. You may not have a control or how many shares you would be allotted finally. You have very low risk management, and 70% of all the IPOs end up losing money, and hence I will not invest in IPOs. So thank you guys, thank you for your time, thank you for listening to me. Like I said, my name is Chetan Potdar again, and if you have any questions, do jot it down so that I could give you an answers to it. Thanks for listening to me patiently, and do keep in touch.